Coming to you on September the 15th with a little bit different view on the world markets, QE from its inception through now, and if I have time, some things I'm looking at for next week. Now, this is the ACWI, which is basically a world index that comprises stocks from the United States, United Kingdom, Australia, Austria, Belgium, Canada, Denmark, Finland, France, Germany, Greece, Hong Kong, Ireland, Italy, Israel, Japan, Netherlands, New Zealand, Norway, Portugal, Singapore, Spain, Sweden, and Switzerland. The components you can find here at usishares.com, okay, and just input the ACWI, and that'll give you the listing of the stocks that are in this particular index, which is pretty substantial. If you go down through it, you can see some names that you probably recognize from around the country, around the world, right? And their weightings and what sectors they're in and so forth. Why am I bringing this up? Well, mainly because this particular ETF has been doing quite well, as you can see if you filter out the noise. And we take this trend line here, you can see that we've broken above this level here. And this is a weekly chart. In this particular week we got quantitative easing, which I'll get to in a minute. And our EMAs are all starting to turn up. Of course, we're embedded, but as you know, if you follow me, I always look at MACD because MACD a lot of times will tell you when a security will be getting embedded and whether or not it's going to turn down. Just simply by following the MACD, you can see, if I adjust this, that we're turning up and showing more momentum. Okay. The last time we embedded in October of 2011, well, we got up to overbought anyway, and we moved sideways and then got embedded in the beginning of the year in 2012. The MACD correspondingly showed continued momentum. Okay. And now we're starting to turn up again. So I'm not saying this is a guarantee, but with the EMAs pointing higher, the QE3 announced by the Fed, the break of this trend line last week, the week before last, and the indicators, momentum indicators, giving us some clue as to the fact that we may be continuing higher. Now, if we look at the QE, I've laid it out on the S&P 500 chart so that we can easily recognize the dates and the levels and the amounts and what types of securities the Fed decided to enter into purchases of. Now, for you newbies, obviously QE is just monetary policy used by, unconventional policy used by central banks, basically printing money because interest rates are so low that they can't really use normal monetary policy, buy short-term government bonds in order to lower the interest rate. However, with interest rates nearing zero, normal policy can no longer be used the way the government typically would. So they use quantitative easing to further stimulate the economy, okay, by purchasing assets of longer maturity and so forth, government bonds, thereby lowering long-term interest rates further out on the yield curve. Now, before the recession, the Fed held between 700 billion and 800 billion of treasury notes on its balance sheet. In late November 2008, the Fed started buying 600 billion in mortgage-backed securities, and by March 2009, it held 1.75 trillion in bank debt, mortgage-backed securities, treasury notes, and it reached a peak of 2.1 trillion by June of 2010. Okay, this red line here, that's June. Alright, the first week of June. This is a weekly chart. Now, the economy started to improve, but was resumed in 2010, August of 2010, when the Fed decided the economy wasn't growing fast enough. You all remember that. So after the halt in June, holdings started falling naturally as the debt matured. It was projected to fall by 1.7 trillion, yada yada yada. And the Fed decided they wanted to keep their holdings right around 2 trillion. All right. To maintain that level, the Fed bought 30 billion in 2- and 10-year Treasury notes per month. In November 2010, the Fed announced QE2, buying 600 billion in Treasury securities by the end of the quarter of 2011. Okay, that's the end of the second quarter, and we can see that we plateaued somewhat. And of course, last week, this last candle here, the Fed announced QE3, right, where we're going to be buying. The Fed's going to be buying 40 billion of mortgage-backed securities per month. All right, with Fed funds keeping them near zero until I think it was 2015. Okay, so why am I showing this? Well, note that when the Fed started buying securities in late November of 2008, that we had a few weeks where we rose up and then we gradually sold off until March 2009, where the Fed held 1.75 trillion in bank debt, mortgage-backed securities, and Treasury notes, as I mentioned before. Okay, and it reached a peak in June. All right. So we sold off a little bit, and then we gradually we took off to the races, and we went from that low of 666 that we all remember all the way up to that high in April of 2010, and then we had the May 6, 2010 flash crash. Okay, where we went from the high of 1205.13 down to a low of 1065.79. So that was quite a crash. And we hit the long-term moving average, the 50 period. We traded down below it, and we since moved back above it. So after the Fed decided that the economy wasn't responding robustly enough, they started with the $30 billion of 2- and 10-year Treasury notes, and we started to cruise up higher again into the peak of 2011, okay, April, May. And since then, we've moved lower, the week of October, where we hit the low of 1074.77 on the S&P, and then we started rallying. We all remember what happened in the first half of 2012. So where do we postulate we'll go from here with further monetary easing? Where will we go from here with further stimulus? Well, zooming in, it sure looks like with on-balance volume fairly low here, breaking above highs, that we could test the 2007 highs up here, 1576. 1576. Let's draw a horizontal there. And of course, a few bulls out there are talking 1600, I believe. 1550, 1600, something like that. Also, going back to the ACWI, the All World Index Fund, we are in a pretty bullish position right now as well on this particular index. And with our highs up here, it's 60.45. We see higher lows, okay, except for this move lower below this level here. It's really a double bottom. For the most part, we've seen higher highs and higher lows. Looking at our MACD, you can see, also note the volume this past week. Pretty substantial. You can see that our MACD is cruising higher as well, so we could get embedded up here. And like we saw on the S&P, after QE was announced, we had a few weeks where we moved higher, okay? Let's take a look at some other instruments too. TLT, you can see we lost the 50 period on the weekly. You can see we also lost this trend line here and this ascending wedge on the weekly going back to 2010. As we all know, ascending patterns typically break to the downside eventually. Okay, MACD's pointed down pretty substantially, as one would expect, and stochastics is moving lower. On the daily, we lost this level here okay, that we bounced on. If you were following GTO, you took a long here, okay, and traded this back up to the 127.50 area. Note stochastics is oversold here, but MACD is pointing down. Again, the reverse is true here, that the stochastics could get embedded if MACD continues to show the momentum that it's showing to the downside. That's not a promise, it's just another observation of what I'm seeing in the chart. I mean, there's other indicators too. When you see Bollinger Bands moving apart like they are, it's showing you even showing you momentum as well in a different fashion. Now we're outside this Bollinger Band, so there are some camps that believe you buy if we close back into the Bollinger Band, and we basically have a three candle reversal. Okay, so you got to watch out for that as well. This is a daily chart. So that was a pretty nasty candle on Friday. And note the volume here. Okay, volume at price. We're getting down into that level here, so we could conceivably see a bounce. Now I had a debate with a trader, or I should say a newbie, who I think he's going to college, who was questioning whether or not I was seeing a head and shoulders top on the US dollar or an inverted head and shoulders on the euro US dollar cross. Okay, when we made this low in July, the beginning of August, I was anticipating that we could move higher and possibly create an inverted head and shoulders, which is basically what we did, obviously in hindsight. But now we have the moving averages moving through the longer term period moving averages, the 150 and the 200, the white line. You have a 10 period 200 cross, and the 20 is right behind it, and there's a 50 turning higher as well. If we zoom out, we can see the downtrend that the euro had been in for some time has been broken as well. So, as Einstein said, and I repeat this ad nauseum, a man should look for what is and not for what he thinks should be. Okay, I try every time I catch myself thinking something should do something, I have to remind myself of that particular quote, which is very appropriate for a trader. You have to look at your technical analysis, you have to look at your fundamentals, of course, but you also have to look what the chart is telling you. What's the market doing? Okay, so we had a clear breakout of this downtrend that's been in place since August, September of 2011. Looking at the Kumo, same thing. Had a Kumo breakout in mid-August. Chiku is on a tear. And this is a very strong chart. Now, I do expect this to pull back and revert back to mean. This is not just going to keep going ballistic. Looking at the dollar, back to 2010, 2011. With that uptrend. Okay, obviously we've broken through our averages. We've been pointing it out for some time. During the same period we were watching the euro, we had this left shoulder and head that appeared after we didn't make a higher high or a higher low. So we pretty much were confirmed when we started seeing the EMAs rolling over and breaking down through the longer term EMAs. So now it's no longer hindsight, it's looking for where we're going to bottom, and the support and resistance levels that are below are pretty clearly defined. Looking at the US dollar from a different perspective, these, obviously I keep telling this each week, that these horizontals are based on point and figure support and resistance levels where price is likely to turn. And we can see that we bounced off of that level here at 78.51, or came very close to it. And if you look at a longer term chart, obviously this is a pretty nice head and shoulders formation as well. So do we bounce here? If we bounce, obviously that is somewhat negative for equities. We could see TLT and bonds bounce, and we could see equities roll over a bit. It's more of a wait and see on Monday, Tuesday to see what happens if we have a follow through on momentum. So that's what I'm watching for. Note in the previous video that I forgot to include Operation Twist, which outlined the Fed's Open Market Committee meeting on September 21st, 2011, where they announced Operation Twist and a plan to purchase $400 billion in bonds with maturities from 6 to 30 years and to sell bonds with maturities less than 3 years. Their thought was they would extend the average maturity of the Fed's own portfolio. It was an attempt to do what QE did without printing more money and without expanding the Fed's balance sheet. So therefore, they hoped to avoid inflationary pressures which were associated with QE. It also brought about a bout of risk aversion in the equity markets and strengthened the US dollar, which we saw during this period. Whereas QE had weakened the US dollar and supported the equity markets. So with QE3, we have to keep that in mind, the fact that previous QEs had weakened the US dollar and supported the equity markets. Okay, so that's what we should be looking forward to going into the short term. So I'm still a little bit under the weather, but I think I'll post this one just for your perusal and to have your own thoughts about what this could mean for the week ahead, the next few weeks, and going into the elections. Okay, so do your research, make up your own mind, but I pretty much put this together for myself and the newbies out there that are wondering where we are and where we're going. Okay, take care, remember to use your stops, and check us out at daytraderbootcamp.com, where you can check us out for a 2-week free trial. I hope this helped.